Hello, everyone. I guess I'm speaking to those people here as well as online as well. Thanks for joining me here today. Um, uh, as introduced, I'm the Chief Investment Officer and partner of Rockstep Capital. 20 seconds on me. I've got 30 plus years of commercial real estate experience, particularly in private equity. I started with a company in Chicago called JMD Realty, was in acquisitions there, ended up being one of three people who ran a company in Canada called Cadillac Fairview with 30 plus million square feet of retail, another 30 plus million square feet of office, industrial, you name it. That's where I cut my teeth. And then moved on to Wall Street. Was on Wall Street for 12 years, ended that stint at Bear Stearns, where I was a global head of high yield real estate, both lending as well as principal trading. And then post that, ran a couple of private equity funds in real estate and a hedge fund and a specialty finance firm prior to joining Rockstep just about 2 years ago. Again, as introduced, my partner, Andy Weiner, started the company about 25 years ago. Andy's experience is retail, literally going back two generations, I believe. Thank you. His company, Weiner Stores, I believe there were 159 stores located primarily in the Southwest as well as Louisiana. It's kind of like a Walmart competitor, and a lot like other Walmart competitors. They didn't quite make it around the bend, but nonetheless, Andy took that experience and started Rockstep Capital. And over the last, there you go, just kind of going to, there you go, perfect, thank you. The company, any real estate company that has specialized in retail has had to do what's called rock stepping. We've had to kind of change our strategy because as anyone who hasn't been living under a rock realizes that the retail business and owning malls and shopping centers and strip malls has changed dramatically over the last even 5 years, much less 25 years. Andy started doing build-to-suit kind of single tenant, grocery anchored stuff, started buying malls when he thought they were cheap in just after the financial crisis, and started buying more of them in 15, 16. And that strategy, honestly, was kind of pure retail, buying what he thought was cheap, buying malls, shopping centers that were cheap, and running them as retail. After I joined, we changed our direction yet again. Instead of buying malls for kind of retail only purposes, we do what we do now is what we call reduce retail beta, which means reducing the amount of retail risk in the malls that we buy, and we reposition it for whatever that market really needs.
Are these malls or strip malls or they're full malls?
We buy primarily internal malls, but we buy lifestyle centers, which are they could be squares, but they're open direct doors into each individual store. We could buy strip centers. We don't buy grocery anchored because they're just too expensive. And by the way, Marty brings up a really good point. If anyone has a question, please ask. It's no fun doing just a monologue. We're obviously a contrarian. Another question?
Sure. If you don't mind, you say that you also convert the retail space to something the community needs.
Thank you. I'll get into that right now.
They're repositioning.
We reposition the assets. Like if you think about most of the malls that you grew up with or have seen, I would say about 95% of them are located in, and I'm not trying to be overly dramatic, incredible locations, whether they're urban like New York City or where I grew up in suburban Milwaukee, Wisconsin. Those malls were located where there were lots and lots of rooftops, great transportation, and growth going on. And now you have those malls, because really no one's building any malls. Another really great investment characteristic. We're not really creating anything new. But you've got an asset type that has matured along with the cities or the towns that they were built in. And when you look at a mall that maybe, and particularly, I want to say a couple of things, and I know I'm talking off this, I've gone way past just that one page. The death of retail has been vastly over exaggerated. We're a vertically integrated company, which means we have leasing, we have acquisitions, we have reporting, financial, accounting, et cetera, all under one hood. So we get to see all of that information. With regard to the leasing, over the last 2 years, we've never been busier. In fact, we just hired another senior person from Brookfield just yesterday, in fact. And we did an analysis at the end of last year, and we looked at all of our major tenants across our portfolio, which is about 10 million square feet, 11, soon to be 12 states in the country. And the amount of tenants or companies that are expanding their footprint versus reducing is 7-to-1. This year, it's far greater than that. The sales in our portfolio is maybe up 20%. We're going to talk about an investment that we're working on right now called Antelope Valley Mall. I'm just going to call it AVM. AVM is now outproducing, forget 2020 because COVID. 21 was obviously up to 21, but AVM is outproducing 2019. And throughout our portfolio, about 75% of our portfolio is outperforming 2019, which at the time when it was completed was the greatest sales year in history. So the death of retail has been greatly exaggerated. And frankly, we love the fact that the Wall Street Journal can't wait to say bad things about our industry because it just makes things cheaper. So,
and Tim, I mean, just
sure.
to bring up a point, there's been a lot of articles about how just because of deglobalization and all the disruptions of the supply chain, just-in-time inventorying is not great. So all these people who got rid of, the footprint, because they said, well, we can just do it just in time. We can store it all out in some place out in Secaucus, that's been disproven.
That has totally been disproven. And what we've seen, again, looking back at our experience, real time in the trenches, only those retailers that have figured out an omni-channel distribution strategy have been the ones that have really thrived. Not saying that you got to have only a physical presence, but when you look at the costs associated with distributing product through a retail channel, a physical channel, it's the cheapest channel there is, not to mention free marketing and advertising. So we like that, but getting back to your question, there are some retailers that haven't done a good job. One great example is Sears. JCPenney's. JCPenney's is a different story. Actually, JCPenney's is actually doing very well over the last 18, maybe even going on to 24 months. But Sears has done a very poor job. And in fact, just last week, I was talking to a guy by the name of Joe David, who's the CEO of Transform Co., which is the prop co of Sears. And I've got 4 or 5 different properties across our portfolio where Sears is empty. But to us, that's not such a bad problem, because again, particularly for those properties that are located in really, really interesting locations, dynamic locations, maybe those properties need those communities, cities need multifamily. They need hospitality. Maybe they need e-commerce fulfillment and distribution. And don't forget the fact that malls, particularly suburban malls, have just an incredible amount of property and parking that you can contribute or really grasp to help with whatever use makes the most sense. So we've partnered with countless developers that specialize in those uses, and we either partner with them or we sell that property after we buy it from the anchor that closed. Or if we own it outright anyway and we're releasing it to Sears, which is sort of rare, but nonetheless, once we control it, we'll either sell the property to another developer so that they, under the assumption and really under the contract, that they build a property that we've already designed and that we've already gotten entitled through the city or the municipality that controls it, which I don't want to minimize is not a small task. Andy and I spent a lot of time working on our portfolio as well as our acquisition targets. Before we even put a bid out there, we know exactly what a municipality is going to allow us to build and what they won't. AVM is Antelope Valley Mall in Palmdale, California, which is it's in the LA County. It's an hour, 55 minutes northeast of LA. This is a town that is growing 2 times that of Los Angeles. Everybody thinks about California and people leaving California because the taxes and because the state is bankrupt. Well, in AVM's case, in Palmdale and their neighboring town called Lancaster, it's growing at 2 times the rate of Los Angeles. And if you could draw a 30-mile concentric circle around Palmdale and Lancaster, you would say it's a red state. And because there's Edwards Air Force Base there, there's every defense contractor in the world there, as well as a company called something 42. Of course, I can't remember it, which is a government-owned, publicly run company that builds the newest, latest great bombers. They maintain the old bombers. They build every drone that the United States uses and or sells to foreign countries. And in this case, so you've got this tremendous kind of red state, if you will, in this not too distant town outside of Los Angeles that's growing, has a great demographic for not only retail. And oh, by the way, the reason why it's really great for retail is it's 105 degrees there 300 days a year, and no one wants to shop outside. It's a little bit of it's an old school mall. We'll talk about that in a minute. But so repositioning and using alternative uses is a really important kind of cornerstone to our investment thesis, because we're buying great real estate for land value. And oh, by the way, the TAM, the total addressable market, is about $35 to $40 billion of literally insolvent malls. The reason why the financial community or the investment community frankly doesn't like retail is because anyone that's been invested in retail over the last 20 years has lost their shirt. And it's kind of hard from the CYA perspective to run them all up the flagpole when you've lost literally billions. A great example of that is Westfield. Westfield came to the United States in like 2004, 2006, and they invested about $14 billion in malls across the country. Garden State Plaza is a great example of it, not too far away from where I live. They invested $14 billion. The estimates is in the 15 years that they've been owning these malls, they've lost about $5 to $6 billion of that money. So try running up an investment up the Westfield flagpole, you're going to get fired because first of all, everyone that bought them, they're all gone. So there's just this pallor, if you will, over the market, and it's allowing us and a few others that are similarly trained to buy great real estate at land value, and which has by definition an internal hedge, which means if we really screw it up, we can scrape the whole thing and build apartments or residential, sell it to Lennar or something like that. And don't think for a second that we don't include that as part of our scenario analysis.
So is it like a base case where you say, you're selling it at, valuate at land value, right?
Exactly.
And can I just give an example? The place where I have a place in Broward County, Florida, and somehow they built two massive malls next to each other, right? Back in, I don't know, must have been 10 or 15 years ago. And the second one, it had two Macy's in it, one on one block, one across the street from it. And it never took off. So they just sold one for office buildings. It went under reconstruction for 5 years. And they, resold it, and then I think about the Galleria in Philadelphia, all the different, Sawgrass Mills, Franklin Mills, all those, overbuilt.
Exactly.
And where they actually, what they do is they kind of like put a big white wall to show to make it seem like the mall is just.
Oh yeah.
When they lose the Sears, they put a big white wall over where the Sears entrance used to be. So.
But that brings up somewhat of an interesting point. And if you could go to, we have page numbers, of course we don't, the investment strategy.
Right here.
Go kind of to the bottom where it says conservative underwriting. What we're basically looking for, I know this almost seems cliche-ish, but we're looking to create investments with asymmetric return profiles. It makes it a lot easier to create asymmetric loan profile or investment profiles, meaning very little downside and very high upside, when there's not a lot of people competing to buy the assets. And two, not a lot of people that understand the base asset, which is retail. You've got to know what you're doing to run them all. Luckily for us, Rockstep Capital has an average experience of almost 30 years. We're old people, and we know what we're doing. We've been around the block.
So when you talk about the addressable market, it's distressed. Are the owners typically encumbered too? Like they really have no other way to move but to sell?
Well, most real estate, with frankly few exceptions, for the large public REITs like Simon, almost all of them are owned with secured capital that have a term. And whether it's CMBS or insurance or banks or S&Ls or whatever, those loans they mature. And when you look back at the prices of malls and see a chart since 2000, it's a ski slope. And those financial institutions cannot get out at par. So the idea is that, and we're starting to see this now, this part of this environment has been just starting to trickle out over the last couple of years. Really, the garbage was sent out early on, but now they're again, Antelope Valley Mall. This is a property that's a top 10% producer. I mean, I'm sorry to say that the owner owns the property at $265 million, and we're buying it for 65. We bought a property in Rapid City, South Dakota, where Mount Rushmore is, that has 8 million visitors a year. And believe it or not, it's a fairly dynamic market. And because of tax reasons, there's a lot of people moving there. It had a $95 million loan on it that's Credit Suisse wrote for CMBS securitization, $95 million. We bought it for 12 and a half, a little less than 2 years ago.
We have about 5 minutes. Can we talk about the deal that
Oh
you're
boy,
buying?
that's not very long.
About 20
That's
minutes.
unfortunate, actually. I was just getting warmed up. All right, so let's go to Antelope Valley Mall. So this is a typical example of an asset that we buy.
This one?
Yep, that's the one. If you could just go just a little bit further. This is actually a whole lot easier of a deal than some of these. We bought the Riverwalk in New Orleans, the Rushmore that we talked about, that there's significant repositioning that needed to be done. This deal, again, it's 55 minutes as you drive out of LAX, not just LAX, even with traffic. This deal is producing. Could you actually go down a little bit so that people can see the investment highlights? Keep going. There you go. This property is producing $500 in sales and over $500 a foot in sales, and with occupancy costs, and that's kind of a tenant health ratio of 11.7%. To give you a context, occupancy cost is a health ratio. It's basically expenses divided by sales for the tenant. If you're below 20%, you're in the minority. If you're below 15%, you're in the top 15%. If you're at 12% or 11.7, you might be in the top 3% in the country, including all these fancy retail establishments here in New York City. This asset is killing it. And it's killing it because the demographics are insane. This is a red state inside of a blue state. And two, because it's hot as hell in Palmdale and Lancaster, California. It's kind of hard to even fathom this deal, but so there's not a lot of repositioning. There is an empty Sears. That's the reason why I'm talking to Joe David and trying to buy the Sears, so that we can build multifamily. As an example of the growth of this town, this area is growing at 2 times the rate of Los Angeles. Again, because of the growth of the defense industry. Believe it or not, what's going on in the Ukraine, what's going on in Taiwan and China is good for Lancaster and Palmdale. So what we look at to kind of figure out how healthy a market is. We look at the growth of starter homes. In 5 years, starter homes have gone from about $285,000 to just over $600,000 in Palmdale, California. I don't know if any of y'all live there. It's expensive. Why? Because they're aeronautical engineers that have to live. And the vacancy rate in the market for multifamily, less than 1%. So thus the reason why I call Joe David like once a week and trying to figure out how I'm going to buy that Sears. Too bad I'm not a very good poker player, but I really want to buy that. Investment goals, we want it just to keep going. There's very, very little competition in fact, there's no competition in the market. There's no other mall. There's very few lifestyle centers because it's too damn hot to shop there. The property is 81% occupied, which is just okay given the great sales it has. But there was a Mervyn's that way before COVID went out, And they are, our seller actually has letter of intents in hand, which is called in tow, for Dave & Buster's and Gold's Gym, which is going to get the property up to 96%. So we've got a fully leased, great property that is killing it in sales, has no competition, and we are buying it for a 13.6% unlevered cap rate. That is our unlevered yield day one. And then when, I'll just get to you in 1 second. And when you include Prop 13, which is the way everything is taxed real property is taxed in California, our actual unlevered yield day one, when you include the savings, because remember, the assessment is $265 million, and this assessment is going to go down to $65.5 million. So our Prop 13 adjusted unlevered yield will be 18.6%. And that's what I mean by our asymmetric returns. Our downside might be 16.5%. And I'm not going to bore. And if you want to, I'm happy to talk to you about on the side about why that there's about 200 basis points. But 16.5% as a downside isn't terrible in today's market. It is because everything that could possibly go bad in this property has already gone bad. And that's part of the tenet of buying malls these days, because you don't have to reach. That's why I think I bought shopping centers, I bought office buildings, I financed every type of hotels, everything. This is the cheapest real estate asset I have ever seen in 30 some odd years of working in real estate. And that's why I stopped doing specialty finance and started getting on this side of the business.
We have time for one or two questions, very brief answers.
What kind of debt could you see on this?
What kind of debt? We put very little debt, 50 to 60%. Our base case returns on this deal is excluding Prop 13, which isn't going to come in for another couple of years, whenever LA County gets around to it, even though we're going to get the full credit. Our base case is like almost 19%. When you include what we're going to do with Sears, when and if we get it, we'll be well in the mid 20s. Yeah.
Yeah. For example, when you look at buying Sears, it's usually the location usually off the highway. So do you take in that type of property? Do you take into repositioning? Do you look at that? You can rezone it for
Of course.
condos or multifamily first?
That's what I meant when we talked to the municipality. I don't know if you were here, you were behind me. We were talking about it earlier, that we talked to the municipality at length about zoning and all the restrictions, and even stuff called a reciprocal easement, REA. We make sure that we can do whatever we want to do before we buy it. We probably my partner and I put in a scary amount of money before we even bid on a property, because we don't want to screw it up. Anyway, thank you very much for your time. I'd like to talk to you about this.